Patrick Taylor, ProPath Financial. We're going to talk about how to take qualified charitable distributions. New lifetime tables. Let's talk about how to take them, how to tax them, and when you can start doing it. First piece of the puzzle, the new age. They bumped this up finally. People are living longer. The new age is 72. It used to be the year that you turned age 70 and a half. Kind of a weird calculation. It just didn't really make any sense, but now it's at 72. The first one you have to take, so the year that you turn age 72, so let's say it's this year in 2022, you turn 72. You got to take a required minimum distribution this year, but your very first one, the IRS gives you a little grace period. The first one is due by the next tax deadline. So for an RMD to not be penalized, you have to pull it out by December 31st. So if you turn 72 in 2022, you got to do it by December 31st. But they give you a grace period for your first one. But all subsequent RMDs for the rest of your life have to happen by December 31st. But here's the kicker. If you delay your first one into the grace period, next year, you got to put basically 2 RMDs on your tax returns. So be careful of that. Subsequent ones have to be done by 12/31. With me? Good. How to calculate. It's calculated off the prior year's December 31st year-end balance. You take that balance of your IRAs and 401ks, and you divide that by the IRS life expectancy number that equates to your age. For 72, it's 27.4. Then I think it goes to 26.5 and then 25 point something. You have to look at the IRS tables. There's 3 tables. This is from the uniform table where it's not a single life expectancy, but you're married and your spouse is close to your age within 10 years, but there are 2 other tables. So this is just a uniform table. December 31st balance, IRS life expectancy. Let's do an example. Say you have $1 million in an IRA. You have $1 million in an IRA. You consolidate all your IRAs and 401ks, you got $1 million. $1 million divided by 27.4, you got to take $36,000 and put it on your tax return as income. The IRS wants that. So now this is going to be income taxed. You've got tax deferral, got a tax deduction up front, so this is going to be taxed. But let's say you have multiple IRAs. So let's say you have multiple IRAs or 401ks, SEPs, whatever. And one has 100,000, one has 500, one has 400,000. Those are all the December 31st balances. I'll write that down. 12/31 balances. You want to calculate each one of them individually. So just remember, calculate them individually. So the 100K divided by 27.4, 500K, 400K, all both divided by 27.4. So you get these numbers. You can withdraw these amounts from each individual account equally. You can do that. You can also total all these up, which I bet it's this number, and you can take them from one account. You could take all these from one IRA. The IRS doesn't care which IRA it comes out of. They view it all as one big pot of money. They just want to make sure the right amounts come out. That's what you need to be aware of. You calculate them all individually, but you can pull these amounts from whatever IRAs you want. They're just going to see these amounts on a 1099-R, as in Roy, that shows that you pulled out the correct amounts based on the prior year's balance. Your brokerage firm or financial advisor should be able to help you calculate this, or you can do it on your own. That's why I'm helping you. Part 3, how do you receive the funds? You got 3 options, essentially 3 options. You receive the money in cash, goes to your bank account, or a check, and you spend it. You just put it in your bank account, you leave it there, you spend it, do whatever you want with it. Because this money's already taxed. So you can put it in your bank, in cash, check, spend it. A lot of times you can pull the money out of your IRA and transfer it if you don't need it to a brokerage account, a taxable account, and reinvest that. If you don't need the money, a lot of times you just pay the tax on it and you got to reinvest that. That's okay. I've seen that happen thousands of times. It's a great strategy. The third thing you can do with it is a qualified charitable distribution. So like I mentioned before, this number right here, the amount that comes out is taxable. It goes on your tax return as income. But what if there was a way that you didn't have to put that on your tax return as income? Like you didn't really need the money and you're charitably inclined, you can do a qualified charitable distribution. What that means is you can take this money, send it to a 501c3 organization, church, charity, school, and this will be excluded from taxes. Normally, the procedure is you distribute the funds in the form of a check made out to the charity or the church or the school. On the check, it's made out to, and then it's care of you as a client. That shows that the money went directly to the 501c3 organization, and that could potentially be moved from your taxes up to $100,000 if you got a big RMD. These are the three things you can do. If you have more questions, let me know. I'm trying to make the video short. There's going to be more videos to come, but RMDs, this is how you calculate it. Can't wait to hear from you. Like, subscribe, share, let me know. I want to keep making videos every day, 365 days. Thanks.